Again, we're going to see what that means. And under 642H-4, it talks about the allocations. Who's going to get the benefit of these deductions? If you look at the example under 642H-4, it says the decedent's estate will use $100,000 to A, and right, that's a specific bequest, and equal amounts to B and C. There's only $80,000 to pay A, nothing to pay B and C, right? Specific bequests get paid before residuary bequests, right? But this $100,000, there's only $90,000 available. There is an excess of deductions over gross income for the taxable year of the estate or trust of $5,000 and a capital loss carry forward of $15,000. Okay, so the deductions over gross income for the taxable year or trust is $5,000 and capital loss. So there's total deductions here of $20,000. Everyone agree? To which both of these co-section 642H applies. As a beneficiary succeeding to the property of the estate to the extent of $10,000, as A is a beneficiary succeeding to the property of the estate to the extent of $10,000, and since the total of the excess deductions and the loss carry forward is 20, A is entitled to the benefit of 1/2 each. And the point the authors are making in the Treasury regulation is that who suffered as a result of these losses? And A suffered insofar as A was supposed to get $100,000, A only got $90,000. Everyone agree that A suffered here, beneficiary A, by $10,000, and is entitled to get the first $10,000 of these losses. Now, let me remind you from our earlier classes. You recall from one of our earlier classes where there was a court case where the IRS took the position, and the taxpayer did too, that losses from a partnership somehow ended up on the individual's tax return. And we all agree that trusts and estates, do losses flow through generally, guys? No, losses do not flow through. One caveat to add to your ever-growing repertoire of tax knowledge insofar as Chapter J is concerned. This Code Section 642H, major exception, right? 642H, for the first time, we see losses, capital or NOLs, or excess deductions passing through to the beneficiaries. Everyone agree? This is anomalous. And what we've learned to date is Subchapter J and 1041s, generally losses are not passed through. Agreed? But here, taxpayer A truly suffered a $10,000 loss. Taxpayer A, beneficiary, is going to be entitled to the first $10,000 of those deductions. Whatever's left, the other $10,000, the residuary beneficiaries suffer, right? And they're each going to get a proportionate share of these losses. Meaning taxpayer A gets 1/2, B and C each get 1/2.
So losses get pushed out no matter what, right?
As opposed to what?
As opposed to say the estate had $100,000 for A, plus those losses, then A would just
A would get the $100,000, and
the losses would split between B and C. Okay.
Right. A dot was due A.
Right. Okay.
Just so these deductions, guys, that end up on an individual's tax return, where do they end up on an individual's tax return? On your 1040, if you got these deductions, excess deductions. Generally, they're going to end up as itemized deductions, right? Subject to the 2% floor. Okay? There's no other place to put them really on the tax return. Okay? Again, NOLs are carried out separately. I'm not talking about NOLs. I'm not talking about capital losses. I'm just talking about the excess deductions.
Okay. Wouldn't that go to-
And the biggest excess deduction is what? You're hoping? Is your accounting fee. Okay? So maybe for years you haven't billed the trust or estate. And now you're going to bill it all at the end. $40,000. But be careful because, again, the beneficiary may or may not be able to use all that. My general attitude, I don't know what your firms do, we just bill annually. You know, everyone can be a hero in this room and say, gee, I'll just bill at the end. But billing at the end, you know, the risk, for whatever reason, the client decides that they're not going to pay you. Or alternatively, they really can't use all the pass-through losses. Okay, so, and maybe the estate or trust has income and your fees are deductible against it and hopefully won't be wasted. So I know yesteryear many practitioners, it was a religious doctrine that they would only bill at the end of the trust or estate, particularly estates. You know, trust could go decades. Yeah, it wasn't going to happen. But I know with estates, many just waited until the very end. But query, does that make sense? Do you put yourself in jeopardy of not getting paid? I think that can help answer that question. Okay. All right, so anyone have questions, or let's start looking at some of these cases about excess deductions. All right, so we have this Alan Newsberg case. And this case focuses on who's entitled to excess deductions on the termination of an estate. We have a decedent who dies in 1925, creating a testamentary trust. And we have Mary, who's going to be a remainder beneficiary if certain contingencies happen. And some 25 years later almost, Mary sells her interest to this investment group for $31,000. So Mary, anxious for money, sells her remainder interest. Now, many times, just to remind you, again, I don't test on this, but I think it's important. Can many remainder beneficiaries, if you're a remainder beneficiary, can you generally sell your interest, guys? Suppose your parent, your father dies, leaves assets to mother in trust, remainder to you. Can you generally sell your remainder interest that's payable, you know, when your mother passes away? Yes or no? Often, 99.9% of the trusts I've seen have something called a spendthrift provision. And this spendthrift clause prohibits, specifically prohibits, people from selling their interest, saying it's void ab initio, meaning it's void from inception. So if you try to purchase it, you're just wasting your money. Because, and you know, most well-drafted trusts have that provision. Otherwise, remainder beneficiaries can essentially thwart your goal, which is to keep the money in trust. But for whatever reason, I can't answer why this provision is lacking. But I've never seen, I mean, maybe on LegalZoom.com you get I think a flawed instrument, but I don't know for sure. I would even think on LegalZoom.com a generic provision would be that. Anyway, in 1956, Mary obviously made a bad deal. Because in 1956, the light tenant dies and Mary becomes vested. Guess how much? Mary sold her interest for $31,500. 10 years later, her ship comes in, or maybe it didn't come in, because how much is she going to get? Or would have gotten if she didn't sell her interest? Poor Mary. $725,000. So Mary was not the savviest, right? Who knows? I mean, I don't know if there's risk involved that we don't know about, but in retrospect, it's easy for me to say that Mary was pretty short-sighted to have sold her interest for so low when she could have commanded so much. All right? And in the final year, trust expenses exceeded income by $134,000. Okay, I'll repeat. Excess distributions were pretty significant money, particularly given the years involved. There were a lot of expenses, $134,000, and Alan's share of the expenses was $14,000. So the court goes into a discussion of who's generally allowed to get excess deductions from an estate or a trust. And generally it's beneficiaries succeeding to the property of the estate. So usually, whoever's named in a will, and if you're not named in the will, the person dies without a will, the intestacy beneficiaries. And the question, right, before this court was, could Alan be considered a beneficiary? Remember, he purchased his interest, right? Everyone agree? He purchased his interest. But as a result of purchasing his interest, did he step into Mary's shoes? What does the court decide here, guys? Is Alan entitled to get the deduction? And the court looks at the legislative history, looks at the literal language, looks at the regulations, and it says, no. He's a purchaser, he's not a beneficiary of the estate. He negotiated a price. He didn't bear the burden of these excess expenses. So this was not what Code Section 642H was to permit. All right, everyone got that? Not a hard case to follow, right? You have much harder ones. But good news for your team, the next revenue ruling is not a hard one to follow. This revenue ruling 57-31. Assume the residuary of an estate is distributed to a trust, which is required to distribute its income to a beneficiary. So you have an estate that's distributing to a trust, and the trust is going to be distributing to you. And it's terminated. The trust is terminated. and the trust has excess distributions, excess deductions, excuse me. Right, everyone agree? It has excess deductions. Can those excess deductions ever flow to you, the beneficiary of the trust? Say again, Patrick? 642H, keep going.
642H4.
What about H4? Let me. There's no H4. You mean, do you mean under the regulations?
Right, under the regulation.
But here's the thing that this, we all agree the excess distributions end up with the trust, at least preliminarily. Agreed?
Yep.
And we know the trust from being here for 8 weeks, we know that generally the trust cannot distribute losses, right? Everyone agree? It's not a pass-through entity like a partnership. So what's the only way the trust can pass through the losses?
If it terminates.
If it terminates, right? So if the trust doesn't terminate, the excess distributions or excess deductions are trapped here. If the trust, in the same year the estate terminates, the trust terminates, the excess deductions of the estate can flow all the way through to the beneficiary. That's it. So the outcome of that revenue ruling is bifurcated. It turns on that critical fact, right?
Can the trust use those deductions against its own income? If it has
It
other
could,
income?
absolutely.
Okay.
And then it just wouldn't terminate.
Okay.
So you have to be strategic in advising your client from a timing perspective. Well, Brian, the commissioner. So this case is going to deal with the interrelationship between the charitable deduction and the excess deduction on termination. So we're going to see the interrelationship between two different deductions, the charitable deduction and the excess deduction. Okay? Factually, the estate had $879,446.53 in gross income. That number is on page 221. Okay? At the very bottom, it points out it had about $879,000 worth of income. But on the top of page 225, it has expenses of $941,000. Everyone see that? When you add up all those expenses, it's $941,000. So the excess looks like $62,403. The question is, that's a pretty significant deduction, but notice, right, the 941. But notice it takes into account the charitable deduction. Everyone agree?
Mm-hmm.
If you take away the charitable deduction, this is spelled out on the bottom of page 225. The IRS computation looks wholly different. It looks at the gross income of the estate, and notice The charitable deduction under 642C is a big whopping 0. Everyone see that? The taxpayer's position is spelled out on the bottom of page 226. It takes the position that you gotta look at the deductions, taking into account the charitable deduction, and you take the lesser of your deductions or the excess deductions. Comes up with this plan. What does the court rule here? Do you take into account for these purposes? Do you take into account charitable deductions? What does O'Brien rule when you compute the excess deductions? Or charitable deductions on the radar screen? The answer is no. Right? So the outcome here, guys, when you're making computation of excess deductions, do not use the charitable deduction as a metric to artificially inflate the amount of the excess deduction. It is off the table. All right, everyone good with that? Excess deductions, guys, comes up in practice fairly regularly. I mean, it comes up virtually every time there's an estate termination, anytime there's a trust termination. The questions about the applicability of Code Section 642H comes up, all right? So this is not something that once in a blue moon. Page 230 talks about realization gain upon distribution of property in kind. And as I said preliminarily, normally a distribution from a trust or an estate, if you looked at, again, revisiting what we looked at before under Code Section 642E, does it force a recognition? And the answer is generally, the general rule is not. Everyone agree? General rule is when a distribution is made from a trust or estate, there is no recognition. But, and this is an important but, whether it be in the income tax course or elsewhere, you guys have heard me say, that generally, if there is some sort of debt, which is due and owing, and an appreciated property is used to satisfy that obligation, is that a recognition event. So if you owe salary to an employee, and instead of paying that salary in the form of cash to the employee, you use appreciated Apple stock to pay the employee, does that trigger a recognition event?
Yes.
Yes, okay? And in your income tax course, you may recall that I referred to the Keenan case, right? And that case is spelled out in your income tax book, and it's spelled out here, right? And this is, by the way, just call to your attention that Keenan is the case that got litigated. And if you go back to chapter 2 of your textbook, because I'm going to want to find this quickly, of course I won't be able to find it, but maybe the Bingham case in chapter 2 talked about the deductibility of the legal fees in the Keenan case. Again, I'm not going to find it because I want to. But there's a lot of litigation expenses that went into this because there's a $5 million bequest. When this person turns age 40, the person was supposed to be paid $5 million. And the trust used appreciated assets to satisfy this obligation. And was that considered a recognition event? And it was, right? Keenan stands for that proposition. Use of appreciated property triggers recognition. I'll just call to your attention the receipt of the $5 million. Did it pull out D&I from the trust? The answer is Dill.
Receive the $5 million by the beneficiary?
I'm sorry?
By the beneficiary?
Yeah. Beneficiary got $5 million. Pull out D&I.
Yes.
Yeah, Yogi?
No.
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 Because of?
Generally.
Say again? What code section, Lisa?
Oh, it's a specific request, 663.
663. Right? Don't forget 663.
When you were, forgot the situation.
663, right? Everyone agree?
Yeah. It's not a regular distribution, it was a specific, but, got it.
Yeah, if you look on page 233, under illustrated material, item 1 says the litigation expenses of Keenan were the subject of, the trust versus Bingham. So at the back of chapter 2, I think there were about $50,000 of litigation costs incurred in litigating this case and whether or not those were deductible. Now keep in mind, you know how we said code section 663 will not apply in the case of percentage bequests, right? Everyone agree? They can't be determined percentage bequests. It's not a fixed dollar amount. So if you don't have a fixed dollar amount, can you have a Keenan-like rate? In other words, if I give 1/2 to my son, 1/2 of my daughter of my estate, and appreciated property is distributed to my son and daughter, my estate consists of 200 shares of Apple stock. So my son gets 100 shares, my daughter gets 100 shares. Is that going to trigger a Keenan gain? The answer is no, right? Because it's not a specific request, right? It's not satisfying a specific request. It's a residuary request. Yes, they're getting each 100 shares. That's just happenstance. Everyone agree? So that's spelled out on the second note in the illustrated material. On page 234, there's a revenue roll, 67-74. Suppose you know, I keep using this example. There's $1 million in a trust, and it earns dividends of $100,000 over the year. Okay, everyone have a visual? There's $1 million of Apple stock. It pays a really nice dividend of 10%. So the trust after 1 year has $100,000 of cash in the form of dividend payments and $1 million of Apple stock. Okay? And you're the income beneficiary, right? You're the income beneficiary. And you're going to get the $100,000, but the trustee pays you with Apple stock, right? Apple stock does not pay you with cash. Okay, everyone have the visual? Does that trigger a recognition event to the trustee? Everyone have the visual? So instead of paying with cash, it pays with Apple stock. And the trustee has an obligation, right? A fiduciary obligation to pay you $100,000. That's what the terms say. Well, that's a debt that the trust owes you. Guess what? I think the way I phrased that, you know the answer. If they use the appreciated Apple stock to pay that debt, it's going to trigger gain recognition to the trust. All right? It's not a specific request that you're using, but it's a debt of the trust because it owes that money to you. If you use appreciated asset, you can cite to Keenan for the proposition that triggers a recognition event.
Which is different. Sorry, which is different from the residual beneficiary in general, just because that's just whatever's left over. It's not.
That's
truly-
different, from, right?
Got it.
Whatever's left over. Now you got that?
So this is only applied to the appreciated assets.
Only if it applies, yes. And when you say it applies if, I mean, if the trustee had distributed the cash instead of the appreciated assets, wholly different outcome. No recognition.
So that means still if they pay you stock, but it's not appreciated stock.
Well, the stock cannot appreciate, but they could distribute, suppose the stock had gone down in value, but they still paid you $100,000. Be careful, if you recall, Code Section 267, related parties, distributions, if you look, I think it's B13, says if you make a distribution of lost property to a related party, the loss is disallowed. So gains recognized, losses, let me check myself. I believe it's 267 B13. It was added. It used to be that trusts were disallowed, but estates could, but they added estates a few years ago. Yeah. 267B13 creates a disallowance. Right? Everyone good? Everyone see that? Look, I'm going to say this now. I'll say it at the end of the class. I think I will, but just in case I don't. Guys, you'll see, after we're done with this chapter, in my opinion, the reading here on a scale of 1 to 10, many of these cases, I think, because your background is, you're not trained in the area of trust and estate. So not only do you have the tax issues that you're regularly confronting, but it's a whole new vocabulary, okay? So I know and you know, I mean, you guys are living it, that the cases that we've read in Chapter 3 are really largely very challenging, okay? On a level of 7, 8, 9, or 10 in complexity. The good news is, beginning in Chapter 4, I'm not saying the cases are easy to read, but they're easier, all right? So there's some light at the end of the tunnel. My message to you, though, is next week, before we start the new material on the grantor trust rules, do yourself a favor, reread some of the stuff we're covering tonight. And if you're lost or troubled, shoot me an email, or at the very start of class, let's iron out some things that are confusing, or I'll say to you, don't worry about that, it's not gonna be tested, or yes, worry about that, it will be tested, make sure you understand what's going on. So before you read forward, I hope everyone reads the material for next week. Try to make sure if over the course of this past week, you took the exam today, for example, you didn't really have a chance to hone in on this material. Really try to hone in on it, okay? All right, so revenue ruling 67-207. At the very top, it says advice has been requested whether decedent's will realize taxable gain when a final distribution of appreciated property is made to satisfy a pecuniary legacy, but is insufficient to completely satisfy a bequest. So here, there is a specific request of $250, just to keep the numbers simple. But there's only $200 worth of property left with $150 worth of basis. So to satisfy that bequest, Patrick, of $250, the recipient's only going to get $200. Will that distribution in and of itself trigger a gain recognition? And the answer is yes. Okay, the answer is yes. When the executor of the estate distributes property remaining in the estate to the designated trustee in creation of the trust, the estate will recognize the $50 in gain. It goes on to say the last full paragraph on page 235. The effect of the distribution will be the same as if the executor sold the remaining assets of the estate and distributed the proceeds to the trustee in the trust. Again, the authors, why are they doing this? They're trying to give you various examples of when there's going to be a specific bequest such that satisfaction of that bequest will trigger a gain. Here, there's not even a satisfaction, it's a partial satisfaction. The partial satisfaction in and of itself gives rise to a gain. There's a revenue ruling, 82-4. As follows. What does this revenue ruling say? Let me give you an example that I've had it a few times in my practice that I hope will help illustrate this. Picture, if you will, a family-owned business, and just for argument's sake, at least in my cases, it's the son who's working the family business. Are family businesses easy or hard to value, guys?
Hard.
Hard, okay? So picture, my most recent example is the estate has worth, how do I say this? During the father's life, he gives the son who's working in the business, okay? Because the son is working in it. And who knows what the value of the business really is, but he gives it to his son, and he gives it at a time where he thinks that it will be efficient from a gift tax perspective. But then he says in his will, because suppose the father, in this case, he had 4 children. So one of the 4 children gets the family business, and he wants to be fair to his other 3 children. So he says, look, on my demise, I want, in this case, I'm seeing his face, but his name is escaping me. John gets the business, but I know it's not John. But John did get the business, or his AKA, whatever. And the other 3 children are going to get the equivalent of whatever the then business is worth on my demise. So dad dies, and again, with a $20 million estate, John owns the business, And let's suppose at the time we know we get estate tax, we get valuations done in the business is worth $4 million, and we had drafted a clause that in the will that said each of his children, before any of the residuary is given, will get an equalizing bequest equal to the then value of the business on the date of the decedent's death, right? So each of the 3 children, before any other distributions are made, are entitled to get $4 million apiece, right? Fair? Why? Absolutely, because the father thought, look, John deserves the business because he's helped build it up, but I do want to be totally fair with my other children, so I'm going to give an equalizing bequest to the other 3, right? The question is, if and when appreciated property is given to satisfy those equalized bequests of $4 million apiece, will that trigger a gain recognition? Right? Isn't that the essence of this revenue ruling? You have an equalization clause. Does that satisfaction of that equalization clause trigger the gain recognition?
It's not a specific amount.
Well, it is a specific amount, okay? It's not going to be reduced for administration expenses or anything. So it technically, in theory, it could be decided the day the person dies that each of the 3 children are entitled to $4 million apiece, right? It's not going to be reduced by administration expenses or anything. So it's tantamount to a specific request. So Code Section 663, I know what you're thinking, will apply. Will the satisfaction of that specific bequest give rise to gain or loss?
If it is a specific request, then yeah.
It would give rise to gain or loss, right? So on the very bottom of page 237, it says that Code Section 663 applies. And then it adds the last line also, under that regulation, the estate realizes gain on the distribution in kind of appreciated property in satisfaction of C's right to receive the distribution in a specific dollar amount. All right? So we have an example of when there's going to be a recognition of it. Right? Now, there's one more revenue. Anthony,
I have a question on that. So, what is the actual gain in your example? $20 million stake, $4 million business, split it in 4.
But I think you have my fact category correct.
Okay.
The $4 million was already given, the company was already given to John before anything was done. Okay, so the other beneficiaries were each entitled to $4 million apiece.
Oh, okay.
Okay?
I follow.
Revenue ruling 60-87. This gets fairly technical, okay? This revenue ruling is not an easy revenue ruling to read. Let me just state what's going on here. Many times, what would happen is that in a state, someone dies, typically the husband dies before the wife, okay? And recall that what is today's estate tax exemption? right now. 2016 is $5,450,000 is the amount you can pass tax-free. Everyone agree? And suppose husband dies with a $10 million estate. Okay? Everyone get the visual? Many estate plans create, are you familiar with the moniker bypass trust? Yes, no, maybe? No. Let me just take a moment out, and hopefully this would help you understand this. Typically, when someone dies with an estate, again, pick your number, but I'm going to give you a number in excess of the federal exemption. So they die with an estate of, so we have a decedent here with 10 million, and the federal exemption we know is 5,450,000. How much does that leave, guys, of a $10 million estate? 4,550,000, right? So, picture that you will, this is a second marriage. So the husband was married, this is wife number 2. And he wants to make sure upon her demise, it goes back to the children of his first marriage, right? So he's not going to leave it outright to the wife, right? Because if he did, she has children from her prior marriage. She certainly doesn't. He doesn't want it to go back. He doesn't want his assets to go to her children, right? So he leaves of his 10 million, 5 million into a $5,450,000 into a so-called bypass trust, and he leaves the other 4 million. This is under section 2056 B. I think it's B7. I'm 99% sure. Q-tip trust or marital trust. You may have heard those terms. Maybe you did. Maybe you didn't. This is under, kind of love my magic marker here. I apologize for its likeness. Bypass trust or B trust. This is known as an A trust. Here's the goal line. Wife has an interest in both these trusts. Upon her demise, she has no indicia of control over this trust. So it bypasses inclusion in her estate. That's why it's called a bypass trust. Whatever this trust grows to, husband dies now, maybe it's like Alfred DuPont, if you recall, his wife survived him by 30 years, right? So this trust could grow from 5,450,000, say, to 10 million or 15 or 20 million. When the wife dies, none of this is includable in her estate, right? She has no indicia of ownership. This trust is called a marital trust, okay, or Q-tip trust. Why? She has no control over this trust, right? But his executors elect that upon her demise, this will be includable in her estate. Okay, so the Q-tip trust doesn't save a dime in taxes. Why? Because it's includable in the surviving spouse's estate, but it allows the husband to control from the grave to make sure it gets back to his wife. And it qualifies for the unlimited marital deduction. So he dies with an estate in excess of the exemption amount. There's still no tax due at his death, but at his wife's death, okay, this will be includable in her estate, and whatever the estate taxes are will be pulled out of this trust. You got that? I'm not going to test you. Again, guys, this is a course dealing with subchapter J. This is information you would pick up in a gift and estate tax course. But I'm just sharing with you what many estate planners do with large estates, particularly for second marriages. Did I lose you? Everyone here? Let me just leave it then for this revenue ruling. You're not going to be responsible for this revenue ruling, okay? Because it talks about what if this is a pecuniary amount, this revenue ruling, what are the implications? We'll cross that bridge a different day. It's not, for our purposes, not important, so you don't need to emphasize this. So let me talk to you about a few things about next class, okay? And then I'll get you in your car in sufficient time for the debates. So hear me on this. Next class, I'm hoping that we have an engaging discussion on things that you have reviewed for material for this class, okay? So that you start off going backwards instead of forwards, okay? And we will then do the problem, we will review the midterm. I hope to have it graded by then. We'll go through the problems and hopefully see where everyone here went right, not where you went wrong. We will then go through the problems on page 242. If you can, try to go through them in advance. If you make mistakes, I think you'll learn more than if you just sit here and say, gee, you would have gotten it right as you've done it before class. So see if you can come up, take a half an hour, 45 minutes, an hour, come up with tentative answers, see if they match based on our conversations. Your key to success here on page 242 is code section what? 642E, 1, 2, and 3, okay? That's your key to success. Now let me just call to your attention chapter 4. Let me highlight some things here in chapter 4. Chapter 4 deals with initially the assignment of income. Many of you recall fondly or not so fondly Lucas Fierro and the fruit of the tree. Who can forget? You have Blair v. Commissioner. These are cases that we've seen before. Helbring v. Horst. Okay, all things we've looked at. Harrison v. Schaffner. Again, all dealing with doctrines we've looked at before. When things get interesting, and this is a very famous case, add it to your repertoire of famous cases. You know, we have Crane v. Commissioner. We have Welch v. Helbring. We have Lucas Fierro. Well, Mr. Helbring has risen risen once again. We have Helbring v. Clifford. And the Clifford case is one of those things that one might say launched 1,000 cases. This case launched many, many cases in its aftermath. And the question that this case, bear in mind the historical context. You know I don't test you on history, right? But if you don't put this in historical context, you will get completely and utterly lost because you'll be thinking to yourself, this is insane. Why would anyone try to have income taxable to a trust? But I'm stating the obvious for everyone in this room, that it behooved you. It could save thousands and hundreds of thousands, maybe millions of dollars, depending on how many trusts you had out there, if you could make the income subject to the trust, right? So people did all sorts of interesting things to make the income subject to the trust, but they didn't want to give up control, right? That's all your clients. They want it both ways. They want to have their cake and eat it too. And Mr. Clifford was no exception. He wanted to ensure that he could make it taxable to the trust, but Mr. Clifford was a control freak. And Mr. Clifford wanted to make sure that he controlled everything and anything that happened here. All right? So bear that in mind when you're reading through this case. And it talks about judicial, where this all started. And then beginning on page 261, what we're going to do is look through various code sections and figure out when the trust is going to be respected as a taxpayer and when it isn't. Okay, so I don't know exactly how far we get, but certainly reading up to page, say, it's very hard to judge given whatever. I don't know. Very hard to judge. And look, I doubt we get to page 292, but who am I to say? All right? Keep reading is my message. Enjoy the debates tonight. I will see everyone next Wednesday, okay?